Out of the more than 3 or 5 books I've read about investing, these are my 8 favorites. In this video, I'm going to show you what the essence of these books is and why it matters. My favorites are, which I think every investor should to read. In addition, I've also read hundreds of books, and actually even more, about psychology, about entrepreneurship, and things like that. But here we're going to specifically talk about my favorite investing books. And very often we get questions about which books I should read as an investor. Well, I think you definitely should want to read these 8. Some of them simply contain crucial features and principles that help you achieve higher returns, but not just returns in investing, but also for your financial security and a bit of mindset. We'll start with the books that are more accessible for beginners, and then we build up to the more that has become investors. If you have any questions about that, just let me know. My name is Jorrit Verliezen. I've been investing for over 10 years. I've built financial freedom, and I think this is the normal starting point. We share through YouTube all kinds of tips to help people with simple investing for financial freedom. And of course, there's also a bit of education and knowledge involved. And as you can see, I keep my favorite books. I really enjoy reading, but the most important thing is that you apply the principles in practice. What's much more important is applying it in practice. So it's better to read a few great books and apply that in practice. Then just read the books and remember, nothing else. Let me know if you have any questions. And finally, I would really appreciate it if you would subscribe. Then you'll increasingly get a place about financial freedom, but also the summaries that we're going to make of all kinds of books. As you can see, just the laughter of being, especially more than 80, I think, and there we will all make summaries. Just gaps are for nothing. They try, keep it as short and concrete as possible. Now let's start with the first favorite investing book, which I think is important for your mindset. The first out of my favorite books for beginner investors is The Psychology of Money by Morgan Housel. Now, what I do with these books is I make highlights of the texts that I think I need to remember for my life. Long. That's why I actually keep my most favorite books. I give away or sell a lot of books, but I keep the best ones. For example, on page 138, it says 1, a text that I always have to remember myself, namely that you should never bet too much money, even if the odds seem mostly in your favor. Why? It's about survivability, and it's about margin of safety. You need to survive to let your money grow. The concept of compounding interest is extremely important. As Charlie Munger says, never interrupt compounding interest. In other words, you should never let your money run out. What else? Compounding is when you create interest on interest, making it worth more and more money. So it's not about whether you're super smart. It's not about making the absolute best investment with the highest possible return. It's about, according to Morgan Housel and many well-known and top investors, that you survive. You put your money down and it needs to survive and grow. And you should never interrupt that process. Never interrupt. That's one of the most important lessons that I personally find very significant about the psychology of money. 2 more interesting lessons that are good to know. First of all, money is always a personal choice. There is no homo economicus. We are not all super rational. Some are more rational than others, and we also make more rational choices. But a lot of us are emotional, and unfortunately some people are just too emotional. So money is a personal choice. Remember that with everything you do. Your upbringing is super important in how you think about money. If you grew up in a very frugal environment, who have always been afraid of losing money, then you probably have something like that wired into you. Social comparison is often a problem too. One cause of financial setbacks, especially when you hear things at those well-known parties about a certain altcoin which is going to go up 50 times in a week. Then you put your money on it. Of course, you're way too late. The altcoin goes up and you've lost all your money. Why? It's all about survival. You just have to make your money work for you wisely and smartly. All you really need is patience. It's so simple to get rich. Anyone who argues against it is just making excuses. First of all, you need to work harder, save a bit more money, and that makes a big difference. That's the same as what you can afford to lose. You just need to invest with lower risk. If you do that, you don't even need to have any knowledge about it. Even though it's only a 6 or 7% return per year, if you do that for 30 years, then you'll be financially wealthy. It's that simple. You just have to survive. For me, that's the most important lesson from the psychology of money. And also another final third lesson is knowing when enough is enough. And that's something that's important to me as well. Okay, when do I have enough? And you can always make millions. But do you really need millions? That's the question. Because think about it, when you start on this journey, it takes something from you. If you really want to become financially free, you can do it in a relatively simple way. But the more money you get, the more important or the greater the impact of, for example, short term. Losing and the more that affects you can be overwhelming. And you can't see that right now. But if you have a lot of money later on, you might start to fear that it will decrease. But if you know when it's enough, then, according to Morgan Housel, then that's at least a step ahead of the rest. But especially for yourself, because it's really about yourself, knowing when to stop. And when you have enough, this was about the psychology of money. His entire summary should I also share on our YouTube channel. So subscribe, definitely, to keep everything together. Because in any case, to keep following all the books. And we're moving on to the next book. The second book you would want to read is The Snowball by Warren Buffett. And this book about Warren Buffett actually reflects his biography from when he was younger, up to today, how he has become a number of very important mindset factors that Warren Buffett has that everyone can actually apply. But of course, if it were easier, everyone would have done it themselves. But the most important lessons I've learned from Warren Buffett is not so much about how smart he has been from a young age to continuously invest his money from cash flow and to reinvest that cash flow. No, the most important lesson I've taken away is he has been very, very patient when markets were overheated. Has he been very disciplined to wait until there were a few no-brainer investments came, and on that he invested a lot of money? The Washington Post is one example, but also others, like American Express. He bought all these great investments when there was a huge crash and no one believed in them anymore. And he, Buffett, did do his research, knew the situation. A third point from this is that Peter only invested money, often, because he was gaining more and more recognition and started investing more money. He also took a position in Howard, and that's how he actually comes in, a kind of active involvement, actively contributing to help that company grow quickly. So it's kind of like the example of, let's say you buy a house and you rent it out. Sure, you do that by buying stocks, but what Warren Buffett did, for example, was he bought the house, he selected a good tenant, and he even trained that tenant to help keep his house in order. And if you do that, you naturally increase your chances of success with an active approach. Warren Buffett has been very inspired. He just waited a very long time, sometimes for years, 10 years long, until a regular investment opportunity came along. And when that investment opportunity came along, he didn't have it. What you definitely want to read is not what Peter E. Lynch. You might not know Peter Lynch. He's less known than Warren Buffett, but mathematically speaking, Peter Lynch has made better investments than Warren Buffett, because Peter Lynch was also able to beat the market and achieve high returns. However, he did this with a billion-dollar fund that was initially smaller and then grew to a number of billion. And that's actually quite impressive because he had to have a lot of positions in his portfolio, and yet he was able to achieve a higher average return than the market. That's a much smarter achievement than a focused investor who only has a handful of stocks, because it can either be completely off the mark, or of course it can easily beat the market average. There are a number of really important lessons in this book, and it's suitable for every beginner investor. You can learn everything from it. I highly recommend reading it. And one of my favorite lessons from it is, I think, invest in what you know well. If you understand something really well, a company, and you know 9% more than the rest of the market, then you have a big advantage in this business. And if you also invest for the long term because you believe in the strong management, and the management takes good care of the cash flow that it reinvests, and the business model is asset light. In other words, a business model that generates relatively a lot of cash flow, but doesn't need much cash flow for reinvestments, like software. Yes, then you probably have a multi-bagger in your hands. A multi-bagger is something that Pitt Technology often mentions, a stock that goes up 5 times, 10 times, or even more than that. And also at Happy Investors, we naturally try to find multi-baggers in our company. Let's take a look at that. Links in our YouTube description with some interesting links that you will definitely appreciate as an investor. A great book for investing that you definitely should read is The University of Berkshire Hathaway. Whether you're a beginner or advanced, the most important principle is also the way of thinking that Buffett and Charlie Munger represent, as described in this book. Awesome. I took a ton of notes from this book. It's really a great book. There's also a lot of humor in it. That's one of the more enjoyable things. For example, if it were up to Buffett to teach a business school class, then he would explain two things as a student. The first, learning how to value a business while determining its intrinsic value, and the second, how to think about market fluctuations. And also Mr. Market and profiting from market movements of Mr. Market. Market is, of course, a core principle from the book The Intelligent Investor by Benjamin Graham, what the teacher was for Warren Buffett. But Warren Buffett has developed much more over the years, developed also thanks to other investors from whom he definitely learned, but all the important principles are actually in this book, probably much better than many courses. And we also offer courses. Of course, I've included the University of Hathaway in our course, definitely a must read. And actually just what I think is the most important lesson from this whole book, and more also what Warren Buffett radiates, is think like an entrepreneur, think like a businessman. It's about capital allocation. There is no emotion involved. The highest achievable return against an acceptable risk profile, that's what you want to achieve. And that's very personal for everyone. One person wants low risk, the other person wants high risk. But what should always be central is you buy a share, you don't buy a digital number or a piece of paper. You buy a company, or is that 39% of the shares is that, well, it doesn't matter. You buy the company. If you could only buy 20 companies in your whole life, would you make that next investment? Yes. No. And now I'm saying this very convincingly, but I also struggle with it a lot myself. For example, I am an active investor. I enjoy investing in relatively smaller growth stocks, and I actually buy too many than I should. Because if I had to think like Warren Buffett, then I would indeed buy 20 in my whole life, and then I would definitely make sure to do thorough research before I buy. But you know yourself, know what your strengths are and also what your pitfalls are. Try to think as much as possible like these brilliant lessons from the books of the best investors out there. To reach the advanced investors, you will definitely want to read the book, Most Important Thing by Howard Marks. The more recent update is The Most Important Thing, Illuminated. That's just a new edition with contributions from other well-known value investors. Now, Howard Marks, here in this book, there will actually be timeless principles that you should all want to learn. A few favorites among them are, for example, on page 11, it describes how you can beat your own market. And it gives a description of assets, in other words, stocks or companies that are especially not well known, that are especially not socially accepted, and that are very difficult to understand. And there are a few more things in there. So you actually have to think differently than the marks. And for a long time, the tobacco industry was an unloved industry. In a company whose long-term potential was a bit hated, not ethical, but you can still achieve high returns with it. Another favorite description on page 23 talks about value. Investors score their biggest gains when they buy an undervalued asset, averaged down conveniently, and have their analysis confirmed. In other words, you buy an undervalued stock, so below its intrinsic value, with marginal safety, and you keep buying more when it keeps dropping in the short term for whatever reason. Volume term investments always have an advantage in the market, but in the short term, there are just many factors that can keep driving the price down, even though the stock is undervalued. But be careful, you want to survive in this market, so never put too much money in an undervalued stock. Another one of my favorite books for value investing is The Dhandho Investors by Mohnish Pabrai. Mohnish Pabrai also honestly states that he learned the best lessons from well-known investors like Warren Buffett, but he explained a low-risk method for value investors with high returns as well. And Mohnish Pabrai is actually an advocate for investing in relatively simple companies that already have a proven business model, also have a bit of margin of safety, but mainly to limit the risk. So even when there is a worst case scenario, you still wouldn't lose much money. But the normal case or the best case scenario will lead to high yield returns. This book is really a must read if you want to learn, limit risks, but still be able to achieve high returns. And if you understand the essence of this book, then you know that it is truly possible. Absolutely one of my favorite investment books that you should definitely read is The Outsiders by William Thorndike. This book really contains a lot of great lessons for investors who want to select amazing stocks. And they do that by choosing the outsider CEO. Now, there are countless lessons. I will make a detailed summary of this, so subscribe to our channel and you'll be the first one That gets an update on summaries of all kinds of great books for investors, entrepreneurs, and more. But my most enjoyable lesson from the outsiders is that because capital allocation is central, with everything you do, you need to constantly weigh your options. What are the best investments? So then you have opportunity costs and you want to achieve the highest possible return, because unfortunately, you only have a small pot of money, and that pot of money is limited. So you want to continuously make the best choices in terms of returns, and we call that capital allocation. The last of my favorite investment books is Masters of Private Equity and Venture Capital. Now you're thinking, private equity, why? Now, earlier we talked about the book Snowball by Warren Buffett and how he actually increased his chances of success through active involvement. Private equity is nothing more than that. The chances of success increased. Private equity is nothing more than that. It's mainly known for leverage buyouts or taking on debt, investing in a company, pulling cash flow out, and possibly inflating a target. It doesn't matter, but I got my money back. Well, that's not the essence of private equity. The essence of private equity is that you first do a lot of deals. In other words, you're really looking for just the most amazing candidates, and from that, you select just a handful that have a really good chance of growing further. Then you focus on value creation. This is also something from Wim Buffett Day. So he joins the board, he goes on the board of a company, and he helps to create value within the company, especially to maintain focus for the long-term and strategic vision. The Masters of Private Equity, really a great book. There are a lot of smart insights in there about how to do this. You might not apply it right away in your journey of investing in stocks, but definitely in your personal life. Everything you do, Master of Private Equity, has brilliant lessons in it that you can apply yourself even in the company you work for. And I can assure you, if you start thinking like an outsider, a CEO, and like a master of private equity, and like a Warren Buffett, then everyone in the company, at least at a higher level, will be happy with your mindset. Because you think like a business entrepreneur, and you think about capital allocation, but of course there are more things, like for example, the importance of management. What is always emphasized in marginal private equity, those people also invest in the team, and ideally you just want to have a really strong team. They also give them shares. Often that's 20% shares, where the investor has 80%, and with that, you actually encourage insider ownership, also that the management team is rewarded for long-term strategic growth, but also start thinking like a business entrepreneur. How does it help you as an investor? Simply put, the essence is if you do a lot more research than the rest in or a handful of small companies where you think that potential for violence in the long term, then you at least know, then you are very well prepared. You've done well in assessing the risks because you want to stay in the game as long as possible. So you don't want to take unnecessary risks. You've already assessed the opportunity, so you also know very well what the company is worth. That way you can calculate intrinsic values, and that way, if you pay the right price, ideally you want to have the margin of safety below that. Something that is natural, Wemberth and all value investors do, and you're basically buying something that is actually worth €1. You buy it for 50 cents or less. Everyone would be happy. Peter Lynch, Mohnish Pabrai, Charlie Munger, they will all be proud of you because you buy undervalued assets for the very long term. And as Morgan Housel also said, it's all about the long term. Stay in the game. Don't invest too much because you don't want to lose too much money. That's why you apply diversification in a way that is beneficial. Peter has too many holdings, but also definitely not too little. We are not employees, let's be honest. So we assume that we will also make mistakes. And that might mean a bit more diversification in the portfolio. Think of, for example, 15 stocks, maybe 20. It will be for the most advanced investors of our caliber. I think that would be the wisest. Now, personally, my journey is going this way, Peter or private equity, because it's not about buying companies for me and sell in 5 years, but it's about investing in relatively smaller companies based on the cash flow, preferably free cash flow, and actually that we hold on for a very long term. You can do this yourself by investing in companies yourself, but it can also be, for example, through publicly traded companies and apply the same principles of private equity, only then for the very long term. A number of really interesting stocks that I call serial acquirers. That's just a name from other sources. Let me put it this way. And those serial acquirers, and I have a lot of that in my own investment portfolios that I also regularly share on our channel. So I would definitely appreciate it if you subscribed helps our channel grow. The more our channel grows, the more money it generates, the more we can invest in high quality videos. And of course, I can then share amazing lessons with you first about Peter only pays for books that help you become a better investor, but also a lot of practical tips just for simple investing to gain more financial freedom. And even if it's just to learn from it. Thank you for watching. My name is Jorrit van Verliezen. I'll see you on Happy Investors or Business Investors. And until next time.